This was a live video taught over on Discord about the weekly cycle, the daily cycle, the 100 pip box, and how to enter in based off of all of that information. I'm not too sure how long this video will be on YouTube or whether or not I'm going to delete it, so let me know down in the comments below if you enjoyed this kind of content or if you would like to see more. I hope you enjoy. All right, so we're going to start out this morning talking about how the market moves. I've shown this before, but I think this is a very good illustration on the day itself of how the market moves around in general. If you understand how the market moves around in the three different levels to start, man, you've already got a huge advantage. And I'm going to use some references here to help kind of explain the market maker or the market's goal in general, because it truly is a beautiful business plan, a business model. If you think of it like that, and the fact that the market moves all based off of human psychology, you know, they have to present certain patterns on the screen to induce and gather money in the market throughout the chart so that they can fill their orders. Once you understand that and you can start to identify these different levels, you are so far ahead of the game already to begin with. So looking at this was gold from, I think last week I showed this 5-minute chart. I'm going to focus on this right here, how the market moves around. Now, all over the chart, you're going to start to notice M's and W's. Not all of them are going to be important, but there's going to be certain ones that you can identify at the extremes, and that's going to generally start the count, right? You're looking for the levels count. Now, this could be at the extremes of the day, which is what we're looking at here. This is a daily separator, so this was all just in one day. But you can look for this exact same pattern throughout the week. If I were to give you this and tell you, hey, this was over the course of 5 days, this could be a weekly template, just as it is a daily template. So how the market moves around is it's going to start at a... No, you sure can't. Oh, we're going to restart. No, I'm not going to restart, but I am going to get it to where you can see what I'm talking about. So the market starts at a peak formation on the day. If I were to show you this whole weekly or this whole daily template and told you that this was a week, it would be the same exact thing. This would be like maybe a Friday. Could be a Thursday. In fact, it could even be a Wednesday from the previous week. And then we're coming into a new week and we're looking at this and saying, okay, well, this is where the peak formation low was formed. And now I need to count the levels, see where we're at within the cycle. Or this could be a Monday. This could be at the very beginning of the week. They put in a peak formation at the low of the current week, and then we're counting up from there. Peak formation low, that's going to be a W, triple bottom. Sometimes you'll get a long run of a larger ascending triangle, and that is all level 3, and then turn level 1 once it, flips around. So once we get the move outside of consolidation, we are now looking at level 1 of rise. But how do I know necessarily where level 1 is going to end? A really cool trick that you can do is throw a little trend line on there, run it across the bottoms, and see where they break the trend, and then draw your high. All right. How does the market move around? We're going to go back into consolidation, which they have. Notice the highs and the lows on this portion of the consolidation here. From that, they're going to hit the stops twice before they shift and put the market up another level. They're going to trap in one direction. Notice how they've made it appear as if the market is going to go long. That would be the first mouse. They spike the high, they spike the low. We get a new W, and then they rise to level 2. You're going to notice that as we go from level to level, there's always going to be, or should be, some sort of M or W, or at least some sort of classical charting pattern to signal the, put in air quotes, the bottom before they move to the next level. So hit the stops, mass confusion, make people believe it's going to go long. They put their stops in a place. Market makes it look like it's going to go short. They get people to start shorting. They hit the stops on the early longs and maybe shake out the weak longs. Anybody who went long off the bottom, causing mass chaos, mass confusion, trap, shift the market, hit the stops, and shift. We come up into what could be considered to be level 2 consolidation. They go back into consolidation between a high and a low. They spike the high, getting people to go long early. They spike the low, getting people to go short, stopping out the early longs. And then they shift the market. There's the W, kind of an ascending triangle here. And then we shift the market up into level 3. Now, this was not at the end of the day. I took this picture prior to them going up into level 3 on gold. However, it's still the same stuff. All right. You can see this is them going back up into level 3, trap high, trap low, and then shift. And if you look at any chart on any time frame and you identify these patterns, you're going to see them, well, once they're in consolidation, convince convince, and then shift. Now, this picture here, I'm going to put this up here. This is a definition. I understand that we're not doing, this is not a war or anything like that, but you've heard people talk about you have to be a little bit cynical in trading. Let me get this to where you can see. You have to be a little bit cynical in trading. Why? What do I mean by that? What I'm referring to is, or what could we talk about, is the psychology of what war is, right? Now, I understand trading is not a war. I fully understand that. I got that. The fog of a war, confusion caused by the chaos of war or battle. Attributed to, I can't say that, forgive me. War is the realm of uncertainty. 3/4 of the factors on which action in war is based are wrapped in a fog of greater or lesser uncertainty. So basically, it's talking about the uncertainty of what could happen, creating mass confusion, mass chaos, and in the midst of that chaos, confusion and all those things, right? In the psychology of what is happening, you can see a lot of similarities in what's being said there. There's a consolidation, and the human mind is, I'm probably are not able to see what I'm talking about again. The human mind is making you believe, based off the patterns and the things that you've previously learned about trading, that it's going to do something, inducing people to commit money at certain areas of the chart and then shifting away once everybody's confused. All right, so that's how the market moves around. They cause chaos from peak formation to peak formation. And then once you give up and once you're so worn down and you've tried so many times, think about this. I keep trying to go short throughout the day because I believe that it's going to go down today or whatever. And I'm so worn out by the end of the day, I give up. And then I come back to the screen the next day and it's rolled over. And all those losses that I took all the way up, I come back and I see I would have not lost any money. In fact, I would have made a whole deal. It hurts. I think we've all been there at least once. Let's try to avoid that. Now, I've put this chart of US 30 up, or not US 30, excuse me. This is oil, and this is from the past, what is this, the back half of a week. And I think this is a really good example that I would like to start with for today. Coming off of a peak formation at the low of the current week from last week on Wednesday. They put in a W. Then from that W, you can see the long run of not necessarily consolidation. They are going higher, but there is a trend line that could be drawn there, and there is a break of trend. They basically attempt to go lower outside of that trend line. They break it, and that will allow you to draw something like this. And that tells you, hey, level 1 consolidation may be about to end. And in fact, you can even see the little W down here, down, up, there's the middle structure, and then the engulfment back up to the upside. Now, this is on a 1-hour chart. Peak formation low, level 1 consolidation, level 2 consolidation. A lot of times, level 2 is going to appear as a running wedge. Level 2 will appear as ascending triangle, some sort of classical charting pattern that will break out and continue up into the next level. Level 1 consolidation, level 2 consolidation, and then up into level 3. Now, level 3 can be a little bit tricky because there's certain variations or different types of variations within level 3. The most important thing that you need to understand is that level 3 will become very choppy. The swings will start to get a bit wide, and they are going to do their very best to cause mass confusion and get people trading in both directions. Sometimes in level 3, they'll just go up into level 3, go sideways and spike, and we'll get one of these. They'll go up, they'll put in a wall, then we have the roof of the house, and then they'll just come right back down. And then sometimes you'll get a level 3 where you have 3 levels ending in a 1, 2, 3. So like 1, and then 2, and then 3. Now, this is a 1-hour chart. If I were to go down to a 15, it's going to be a bit more clear how they've came up once, and 2, and then 3. So 3 levels ending in a 1, 2, 3. And on that last leg, they're going to do everything that they can to convince people that this is going to continue to go higher. And then they're going to pull the floor out from under you. All part of the mass confusion, the mass chaos. So what do I need to look for in each level? Let's break it down by level. Now, remember that picture of gold that I just showed you. And I told you that 5-minute chart of a daily template, you can use that throughout an entire week. Let's start in level 1. Once you get a peak formation low and you get level 1 rise consolidation, do not counter trend level 1 consolidation. Level 1 is the most risky place within the chart to try and find a counter trend trade within the cycle. Steve Morrow talks about the W, the anchor point, and he tells you very plainly, do not counter trend level 1 consolidation. Stacey Burke says, do not counter trend the peak formation, level 1. First green day, level 1 consolidation. We're looking for a buy low opportunity only, because we are in level 1 consolidation. When you get up into level 2 consolidation, now we can maybe look for a high of day opportunity depending on how the day's template has formed, and I can look for a counter trend trade in my session. So let's say, for example, Asia has put in a low, maybe London's put in a high, New York trades back up into the high, maybe first hour of the session, maybe even the second hour, and you get that stop hunt back down into the low. Now that stop hunt could come in the form of, and probably will come in the form of, 3 pushes, 3 drives down into the low. However, if that high to low range is more than, 50, 75 pips, that gives you the opportunity to take that trade, but it is a scalp and it is counter trend. But overall, if the daily template has presented, let's say that Asia has put in a low, London has put in a high, and you come to the screen, and this is what the chart is looking like. First hour of New York, or maybe even coming into the second hour of New York, I'm in level 2, and I can take a with the trend trade coming off the low of the day, locking in that peak formation at the low of the day. And now I'm along with the trend, looking for the trend trade back up to or through the high of the day and back up to previous day's high. Provides really good risk to reward opportunity. You're in level 2, taking a trend trade with the trend. It's expected to do a expansion of the range, just like it's done here, right? Something like that. Now, once I get up into level 3, what do I need to look for in level 3? I stopped looking for buying opportunities with the understanding that I'm in level 3. I'm only going to look for 2 types of entries. Second leg, M or W. In this case, it would have to be an M because it's at the high of the day and high of the week. And I'm going to try and catch the second leg of that M or W. So in this case, whenever they put in a middle structure, this big up close candle, and then they put in a down close candle, you can draw a line here and wait for them to trade back up into that. So let's say that, hey, I've noticed this. They put in a middle structure. We're at the high of the day. Things are looking good. Draw a line there. Wait for them to trade back up into there in a lower time frame within your session, and wait for your entry criteria to play out, if it plays out. The other type of entry that you can look for is, if that M or W is already formed, you draw that neckline and you wait for them to trade back up into that neckline within your session. They're going to trade back up into that neckline in some sort of 3 push variation, and that could be considered, in air quotes, locking it in. They lock in the low, or lock in the high, excuse me, and then now I can look for a short trade. No, I am not recommending you go and look at oil right now and try and take a short trade. That is not the purpose of doing this. It just happens to be doing what we're talking about. Now, within each of these, remember I said that before they go up to the next level, they are going to cause mass confusion. They're going to spike the high. They're going to spike the low. And that's very evident even right here. Spike the high. Look at this candle. There was a consolidation. They were going sideways, and they spiked up. Got everybody to start going long. Look at the low of this consolidation. They spiked the high. They spiked the low. And then they put in the W at the low of the day to continue. This is only over the course of 3 days. This is 1 day, 2 days, and 3 days. And within those 3 days, there is 3 levels. If you've listened to me long enough, or if you've listened to Stacey, or you've listened to Steve Morrow, whoever, you know that it doesn't have to present just over the course of 2 to 3 days. Now, we're looking for 2 to 3 days. Sometimes this will just keep going, and that's perfectly fine. We might be doing a larger range expansion. Sometimes it'll present slightly different. Maybe we get a peak formation at the low of the day and 3 days of breakouts, which is one of the signals that we're looking for, 3 days of breakouts. But overall, this is 3 days of rise. This day opened here. They attempted to go lower. They closed above the open. That's the first day of rise. First day of breakouts comes the next day, but that's the second day of rise. Now we're into that 3rd day of rise in level 3, and that gives us the opportunity to look for the reversal if it were to present in our session, which it did perfectly. I don't think it could have been any more perfect in the London session for more than 50 pips. I also said that I was going to associate this weekly template with the different trading setups. All right, so let's draw this pattern real quick, and I'll come back to this chart in a second. If you have a down moving market, and then you get a peak formation made at the low of the current week. This is where the day opened. They attempted to trade lower, and then they closed above the opening price for that day. Well, we're in level 3, or we're down low, and now we have what could be, or is, your first green day. Now we're associating setups to the idea of the market maker template. Level 1 of rise, the following day. Do not counter trend the peak formation. I'm looking for a buy low opportunity. That is it. There's certain scenarios that can wrap around that. Sometimes they'll come back down, retest trap volume zone. Sometimes they'll just consolidate and then spike the high, spike the low, and continue. But at some point, they're going to put in a W, and I'm going to look for one of those two types of entries. I'm either going to look for the second leg of a W, which would be like a low of day buy, or I'm going to come to my session and see that a low of day was already put in place in Asia, or maybe even London, and they trade back down into that W for me to get my trade. All right, cool. So now we rise up, level 2. Level 2 consolidation. We're up high. They've been going sideways. They start to pump it up a little bit, and then they put in a peak formation at the high of the day. Maybe Asia put in the high, and then London trades back up into the high. Maybe I'm trading in the Asian session, and I can catch that second leg of an M. Maybe they've put in the M, traded back down, and then come New York, they trade back up into the high of the day, and I can get a sell for the stop hunt back down through the low of the day. However, overall, the most important thing is I'm in level 2 in part of an uptrend. I need to look for a W at the low of the day. So if there was already a peak formation put in, maybe from earlier in the day, frame your day, they trade back down into that New York session, I can get in based off that peak formation. However, if that low was not put in place and they keep going lower, I know that I need to wait for that second leg of the W. Then we get a rise. We come up into level 3. Do I really want to continue to look for buying opportunities in level 3 where that is the buying trap? No. Now the process is going to repeat. I'm going to frame my day. I'm going to look for Asia to put in a high. I'm going to look for maybe London to put in a low. I'm going to look for a lower low being put on the inside, starting to look at market structure. And then I want to see them either trade higher, maybe put in a new M, or I just want to see them trade back up into an already pre-existing peak formation that was made earlier in the day. And then now this process is going to repeat. First green day, 3 levels of rise, 2 to 3 days of rise, 3 days of breakouts, or 3 days of higher close. And then you get a first red day. Okay, so now we have first green, 3 levels of rise, and now we are up to first red. After first red day, they stop hunt back to the high, peak formation. Maybe there was already a peak formation made earlier in the day. They trade back up into it. I can get my short trade. Now we're going to do 3 levels of drop. That is the market maker cycle. That is the templates that we're looking for and the trading setups that are associated with both. Level 1, do not counter trend. Level 2, gives me the opportunity to look for both. I can either look for a counter trend trade depending on how the daily template is set up. That's going to provide a decent scalp, 25, 50, maybe sometimes 75 pips. The overall trade that you want to catch, or the overall trade setup that you want to look for, is the buy low opportunity to rise to level 3. Once you're in level 3, start looking for the sell opportunities, M's, high of week, midweek reversal, and then looking for trend trades on the way back down. Right. Now, I told you we're going to focus mainly or a lot on the entries portion of this. So we can do that. In fact, we should. We need to look at the 100 pip box. We need to look at market structure and paying attention to how the day is forming. So let's take a look at this Thursday. Since we're focused mainly on oil right now, we're going to start lagging and do all kinds of weird stuff. Come on. Don't be weird. This is good. This is what you all came for. A lagging chart. Well, while this is loading, is what I'm going through so far making sense? See if we can manipulate the system. All right, you all are seeing what I'm seeing. I pulled up a 5-minute chart. Okay, so this is all in hindsight. I've already identified on the day itself, like if I can't see anything to the right of my cursor, this is all the stuff that I'm doing the day before I even come to the next day, before the first candle even prints. So yeah, it's in hindsight. It's a signal to watch for the next day. Now, sometimes, do not get me wrong, sometimes they'll put in a peak formation at the low of the week, and then it just collapses, and you're like, man, that stinks. But it's going to put you in a very high percentage of times looking at the right thing. And if you can frame your day appropriately, your win percentage and your risk to reward is going to go through the roof. All right. So let's take a look at this day. What would I need to do on this day in order to have a better success rate? Or what would I actually need to be looking for? We'll come back to that. Nope, wrong one. That gold example I showed you. Now I need to frame my day. Just like I would frame the week looking for weekly opportunities, I need to identify where my peak formations are on the day. Okay, so in the Asian range, the Asian box, I have a peak formation at the high of the day. How do I know this is a peak formation high? It's a triple top. It's at the highest point that the market has traveled. It's put in an M, and it's given me a very solid neckline. All right, so there's a peak formation at the high of the day. Markets traded down and put in a peak formation at the low of the day. So I know there is a peak formation at the low of the day and at the high of the day. Okay, this is all prior to me even coming to my session. Now, this is all, what is this? Gap time? So in the gap time, they traded back down into the peak formation, put in a W at the low of the day, and went vertical. Let's take a look at the 100 pip box. See if I can clarify some stuff here. This peak formation, they're trading in between a 25 pip box. And this peak formation was put in just around double zeros, $82 even, which means that $82 even might be my level to watch, the low of the current day, and also the peak formation that was put in earlier in the day. So I've got options. Number one, market might trade back down into that level and put in a W and reverse, which is what has happened here. This is them, in air quotes, locking it in. That would be an example of them locking in a peak formation, locking in the low of the day. But if I don't have that W, or maybe I've missed it, they trade down to double zeros in a 1, 2, 3, and this is a 5-minute chart. We go down to a 1-minute chart, which is my entry time frame that I'm always looking at. We can look at those same levels, and you can see they've came down in that 1, 2, 3 and put in the W at double zeros, peak formation low. If I've missed the second leg of this W, probably because it's in the gap time, right? If I really want to counter trend, level 1 consolidation. Look at this trend line trick. This is the first place that they broke that trend line. This is level 1 consolidation. So if I've missed the W, at least I can get in level 1 consolidation on the 1-minute chart on the way back up. All right, I'm getting in at double zeros in level 1, and then now we can rise and continue. You go back to the higher time frames, and they will complete that daily pattern. Peak formation, low of day, 3 levels of rise, ending the day in consolidation, and then we come into level 2, and now we're up into level 3 for the week. And now we're into a new week as well. All right, so we come into a Monday. What do we need to be looking for on a Monday? Well, our only levels or our only reference is the previous week's high on a Monday, previous week's high, and the previous day's high and low from Friday. We come into the day understanding that we had level 2 and we're going into level 3. We're starting the day at the high of the week, high of previous week. We triggered previous day's high. We're in level 3. Let's drop it down and frame our day. Market makes a big run up. Remember, I said level 3. They're going to do everything in their power to make you believe that that market will continue in a direction. Push 1, push 2, level 2. Push 3, level 3, consolidation. Spike the high, make you believe it's going to go long. Spike the low. Actually, this was spike the low first. They spiked the low first, convincing you that it's going to go short, which you're right. You just timed it wrong. This is the first mouse. This is the break-in structure to the downside. So that's the lower low on the inside that we need to look for in level 3. Then it makes a run. Get everybody to go short early, cause mass chaos, right? Get everybody to go short. They put their stops at the high because that's what the books tell you to do. 1, 2, pause, 3 to the high. Hit the stops, pull back down into consolidation. Looking for second leg, M or W. First leg M, second leg M. All right, so this first peak formation that was put in right here, or the first high that was put in place, was at 350. Let's go down and take a look. Where is the 100 pip box, and what level was that level formed at? We already have a peak formation low put in place at the low of the day, and now we might have a peak formation high put in at the high of the day. Peak formation low in Asia, peak formation high in London, 100 pip box. What level was the peak formation made at? They made the peak formation at 75, which means 75 could be my level to get in. This is the level I need to watch. You can draw the neckline. If they return back to that level, might give you an opportunity. If they trade back up into 75 on the second leg of the M or W, in this case, the M, that might give you an entry. Okay, let's go down to the 1-minute chart. Let's look at the entry time frame. We already have a lower low on the inside. Break in structure, 5-minute chart. Peak formation low, W. Look for 3 levels of rise. 1 consolidation, 2 consolidation, level 3 consolidation. Level 3 means nothing unless they give you. So now we have a peak formation high on the 1-minute chart and a break in structure. This is a valid entry. However, the 1-minute chart just made a lower low, so they might trade back up into 75. If you don't take this aggressive entry coming out of level 3, that's fine. Wait for them to pump back up. So lower low, 1-minute chart, and it pumps back up in 3 pushes. There's the little W, runs it back up and gives you the M at 75. Remember, that's the level that we want to be watching. And there's the engulfment. That should have been the entry. That could have been the entry. It's pretty aggressive, but this is the less aggressive, safer entry. Now, like I said, 50, 75 pips. This one went 50 straight down. Perfect. That's exactly how it should behave. Now, looking at this chart, I have no idea what's going to happen for the rest of the day. Genuinely, I really have no clue. But if this is level 1 consolidation and they broke right here, maybe this is level 1 and 2. We're spiking back up into the high. I have no idea. Maybe this is because of a higher time frame. Now it's going to roll over. Who knows? So to kind of recap some of the things that we're talking about or have talked about. Market maker templates from peak formation to peak formation. Lows of week, lows of day, Asian range. And from that, you can expect 3 levels of rise or fall throughout the day, throughout the week. Peak formation low, 3 levels of rise throughout the week. Level 1 consolidation, do not counter trend. This is going to appear after a first green day. Buy low opportunity. Level 2, I can now look for potential counter trend trades if it presents in that manner that I just showed you, right? Looking at the 5-minute chart, you frame your day, you identify, hey, they've traded back up into a peak formation. I've got 50, maybe 75 pips of distance back down to the low of the day. I'm going to trade the stop hunt. It's a scalp. But overall, I'm in level 2 and I want to get that 3rd level of rise. That's the big move or the true trend for the day. Second leg. W. Once you get that middle structure, draw your line. If they trade back into it, look what level you're at on the 100 pip box. Where was the first level made? If they trade back down into that level, that's my level of the 100 pip box to be watching. Big run up. Level 3. I'm now not looking for trend trades anymore. I'm no longer looking to go long. I'm going to look for evidence that I'm correct. I'm at the high of the week. I'm at the high of the day. Maybe they've triggered previous day's high. I've got a peak formation made earlier in the day, or I have a peak formation at the low of the day, and they've done 3 levels of rise and put in first leg of an M. My session opens up. They trade back up into the high to give me the second leg of the M. Look at the 100 pip box. Figure out where that level could be formed. Once they drop down within that week and I'm in level 1 consolidation, I come to the next day, people are getting caught up. Well, you know, it started going down, so I'm going to start looking to go long. Retail loves to counter trend. There's no reason to if you're in level 1. Had a first red day yesterday, level 1 consolidation, do not counter trend. I'm going to look for a high of day sell. Now let's talk about a little variation here. Sometimes you're going to get a first red day and you're like, okay, tomorrow I'm going to look for a sell, as you should. But one thing you need to pay attention to, what happens if, let's get rid of this. What happens if we're doing a larger range expansion? If the market just did 3 levels up and 3 levels down, the market would stay ranging forever. Higher time frames, sometimes they're going to continue to trend. And that is where peak formation resets can sometimes happen and catch you a little bit off guard. So you need to look at, how did this day present? So if this first red day came down once, maybe twice, 3 times, brings the market down super low and 3 levels of drop. Next day opens up, you're at the low of the week, current week. You get a peak formation low and you come to the screen, there's already a really big W in place. This might have been a peak formation reset. So if I were to put like a daily separator here, peak formation reset, and they do something like this the following day, and you're dumbfounded. You're so confused. That's why framing the day and understanding the peak formations and where you're at within the week are so important. Let's take a look at the US Swiss. First red day trap, exactly. Let's take a look at the Swiss. Strongly trending market. First green week. Peak formation low at the low of the current. Was that the month? Yeah, this is. Peak formation low at the low of the current month. First green week. First week of rise. Second week of rise. Third week of rise. Peak formation high. But what I want to focus on is this part right here. First week of rise, level 1 consolidation. Trend line trick. Level 1 consolidation. Rise to level 2. Spike the high, spike the low, they move up to level 3. Could not be better, right? Peak formation at the high of the week, current week, and it spikes back down into the low. I think this was the Fed, giving you a first red day. Following day, I'm looking for a short trade. Yikes. Market came off that peak formation at the high of the current week and brought it back down really low, really quickly, and then went vertical. Should I start to look for counter trend opportunities? No, this is a peak formation reset. If this was not a reset, it would have traded back up into this level here. That is definitely not what happened. They went higher, so this peak formation is now void. If they go higher or lower, the previous peak formation is now invalid, and you can expect 2 to 3 more days of rise or 3 more levels of rise. Level 1 of rise, level 2 of rise, level 3 of rise, high of week on a Friday, reversal, New York window. All right, let's go back. Let's take a look. Let's frame this day. Okay, so now we've identified, okay, this is a peak formation reset. I need to look for 3 more levels of rise. Those are all set in stone rules. That's not hindsight, but it kind of is because you can see 1, 2, and then maybe now today I need to look for 3. That's a pretty solid thesis or analysis or idea. On the day itself, I frame my day. I look at the peak formations. I identify where's my low, where's my high. Peak formation low at the low of the current day, 3 levels of rise. We get to the high of the day. They put in a new peak formation, up, down, up. They engulf, and they work that neckline. So if I come back in my session or coming into my session, and there's already a pre-existing M or W, then I can look for them to quote-unquote lock it in. So lower low on the inside, break in structure. Lower low on the inside, break of structure. Trades back up into the high. There's the W, level 1. Or push 1, push 2, push 3, lower low, 3 pushes, 100 pip box. Let's see. Was there a level I could reference with the 100 pip box right there? Okay, so they're putting peak formations in above double zeros, which means I just need to get in above double zeros. Is that above double zeros? By quite a bit, yeah. They engulf back down to the downside in my timing window. Opportunity. Profit targets, 25. 50 pips. This is the Swiss, so it's probably going to be a bit smaller. 25 pips on the Swiss is massive. Why is 25 pips on the Swiss massive? Because if I put my stop above the peak formation or at the peak formation or above push 2, whatever, and I take 25, risk to reward. Beautiful. And that is how you use the 100 pip box. That exact process that I just went through, narrowing it down, looking at the levels, identifying on the day where my peak formations were made, and then when I'm narrowing down my entry, I pull up the 100 pip box and see where were the peak formations made and at what level, and I just need to get in around that level. And that's how you narrow down your thought process from top to bottom. As far as my entry criteria goes, if I am in level 3 at the high of the week, sometimes I will take a fairly aggressive entry just using the level and the engulfments and things like that. However, I would prefer to see a lower low on the inside, a break in structure, which we get on the 1-minute chart, and then 3 pushes back up into the high and a chart pattern, which you can see the little inverse head and shoulders here, right shoulder engulfment. All right. These are not cherry picked. I've literally just gone and basically grabbed the first couple charts that came to mind. You can go back. Please, 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 please do your own research. Don't just take what I'm saying for granted or whatever. You know, go back and back test this a million times and you'll see it, hopefully.